The market's really got to decide what it wants here, and that's partially why I think we're still sort of trying to find a level a little bit. We've got two schools of thought. The bond market is telling us quite clearly that they're afraid of a recession. You know, we could spend another hour going through every inverted yield curve or parts of the yield curve, but it's quite clear that there's an inverted yield curve, which is usually a very bad warning sign about the bond market fearing a recession. And the bond market tends to be more right than the stock market, although they overpredict recession. But so, that would bring the rate cuts. There's rate cuts priced in, 2 rate cuts, let's say, within the next year. What's going to give us those rate cuts? It would have to be a recession. And the stock market, I think, is sort of fixated on this idea of a soft landing and then sort of taking that to some magical thinking about we're going to get an okay economy and rate cuts. It's not going to happen. The Fed is told that, first of all, just think logically, besides whether or not you trust what the Fed people tell you that we're not going to cut rates, blah, blah. If you've went to all this trouble to hike rates at pretty much the fastest pace that any of us have ever seen, are they then just going to turn around and say, oops, my bad, we're going to start to cut them like 2-3 months later? No. They'll only do that if there's a reason. And be very careful what you wish for if that's your investing philosophy. I think what we're going to have to see is some idea of whether good news is good news or good news is bad news, and vice versa. And I think if we want to see the good economy, we want good news to be good news and bad news to be bad news, that kind of idea. And I think we're still getting mixed messages in terms of how the stock market's reacting to things.